The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everyone, and welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick. These are your headlines. Asian equities brush off China's slowest GDP growth in over a year as the central bank kickstarts stimulus. Bridgewater Associates founder Ray Dalio tells CNBC the support needs to be more targeted.
Just throwing a lot of money in credit, everybody says that. That's not, you need to do it correctly. And that's part of a restructuring. That becomes the challenging part of it.
IMF Managing Director Kristalina Georgieva tells me that governments have to tackle high debt levels, but sounds an optimistic note on the fight against pricing pressures.
We have managed to turn the tide on inflation successfully without the world falling into recession.
The ECB delivering a back-to-back rate cut for the first time in 13 years, citing weakness in recent economic data and progress on inflation. The ECB President, Christine Lagarde, signals there's more to come.
The disinflationary process is well on track. And all the information that we received in the last 5 weeks since our last monetary policy decision, we're heading in the same direction, lower.
In corporate news, Netflix reports its most profitable quarter ever. Shall I read that again? Its most profitable quarter ever. Isn't that extraordinary? Adding more than 5 million new customers and eclipsing estimates as its strategy shift starts to pay off.
Israeli forces kill Hamas leader Yahya Sinwar, the chief architect of the October 7th attacks, as Prime Minister Benjamin Netanyahu hails the move as the beginning of the end.
A very good morning. How are you?
Very well, thank you.
Yeah, and did you enjoy your different kind of shift? I always find it a bit discombobulating when I'm doing a late shift, but you did Decision Time. What was the most interesting one fact from Decision Time?
That there was just no pre-commitment to any future rate cuts. However,
extraordinary.
All the data the last 6 weeks has been going in the one direction, that is down.
Yeah. Isn't it extraordinary that we get an SEP, we get a minutiae all the way out from every single member of the Fed, but the ECB, they feel the opacity is the better way forward.
Absolute no commitment. So the question is, what does the market do with it? They ran with it a long way, and there are price cuts everywhere as far as the eye can see, and even some discussion around jumbo-sized rate reductions. That did not come through from the ECB, though. So to me, what is pivotal, that it was not put on the table. So Philip Lane, the chief economist, did not put this on the table to be discussed at this meeting. It was only a 25 basis point rate reduction. So the question is, next time, if conditions all continue to go in the same direction, does he serve up a 50 basis point cut as a point of discussion?
Well, 50 would be interesting.
As a discussion. Again, there was no word of this.
What have we had now? 3 from the ECB,
ECB,
haven't we? 3, but 2 back-to-back.
Two back-to-back, 3 in total. And very weak conditions playing out.
Brilliant. Well, thank you for that. There you go. I've learned something already. There you go. 3 minutes past 6 and you've learned something. China's economy has marked its slowest expansion since early 2023. Third quarter GDP grew by 4.6% year on year, slightly above estimates, but slower than the previous quarter and moving further away from Beijing's own 5% annual target. We've had other key data coming out of China today. Industrial production picked up pace in September, growing 5.4% year on year, beating analyst expectations. Retail sales grew by 3.2%, also ahead of forecasts and higher than the previous month. And year to date, fixed asset investment expanded 3.4%, also a touch above Reuters estimates. Sam, I find this extraordinary every time we get the quarterly data out of China. Not the fact that what the data actually says, the fact that it's done so quickly in the world's second largest economy, and it's done and it's set in stone. In America, for instance, we've only just had 3 weeks ago the final figure from the second quarter, I beg your pardon. But the Chinese, only a couple of weeks after the end of the third quarter, have given us the definitive data. Aren't they clever?
Aren't they, Steve? Very good morning to you. Well, what we got today arguably is also a bit backwards looking, given everything we've heard from the authorities in recent weeks about all this stimulus. But even though it is perhaps arguably a bit academic today, it is good to look at the trend, because what we got today was a beat across the board, as you say, but it didn't really tell us anything new. It was based on low expectations. That's exactly what the folks over at Goldman Sachs sort of alluded to as well in their note, their sort of quick take off the back of this, given that we did see things coming in marginally higher than what the market was forecasting. The retail sales, yes, it got out of that sort of 2% range that it's been stuck in for some time, but still fairly subdued, just in the range of about 3% now. We do know that consumption still needs help, and we still need to see more on the demand side of the equation. The industrial output, yes, that was also a beat, but it didn't really tell us anything new as far as encouraging signs on the supply side. We know that there's been a lot of attention on investment in the manufacturing sector, even as those exports did come off a bit in September. The fixed asset investment, we still saw a big drag with property investment as well, down about 10%. And then the jobless rate, that ticked up, which was certainly encouraging. But just as I said, some marginal improvements across the board, but not as much as is really needed, I think, as far as the markets are concerned. There has been some suggestion that as far as the rally we're seeing in Chinese stocks, maybe there is a bit of national team at work here today, but that, of course, is just market chatter. I'll leave that up to others to decide what they think of that. But, as far as the stimulus is concerned now, it very much looks like they are trying to address some of the debt risks and the property sector rather than massively stimulate demand. And that certainly is what the market seemed to have a bit of a problem with, is that all they're seeing in and hearing from this, especially the housing minister yesterday, is supply, supply, supply. And so now I think, what the market is looking for is if we do start to see that translate into more demand. We're speaking to some folks over at Maybank who said that this 4.6% GDP growth is bang in line with their expectations. If it can sustain the momentum, if we can continue on this trajectory, it should hit about 4.8%, and then that would fall in the realm of around 5%, what the government is looking for. I'll send things back over to you guys in London.
Thank you, Sam. Lovely to see you today. I don't know if you've got to see us a bit later on, or we'll have as live from you, but either way, thank you very much indeed. We'll catch up later. It's extraordinary, isn't it? Again, my first question is, oh gosh, aren't the Chinese clever by having the definitive data just 2 weeks after the end of the quarter? My second question is, how good a barometer is the stock market for actually what's going on in the underlying economy? I would suggest pretty rubbish. And that's not Chinese, by the way. That's across the board.
But China is a special feature when you have the state machine potentially also active in the market. So yeah, it's not really a barometer, is it?
No, but Main Street and Wall Street has always been the question, isn't it? It's a question we've asked perennially as well. We've got some other views on this, actually. CNBC's Martin Sung, as opposed to someone else's Martin Sung, spoke with Bridgewater Associates founder Ray Dalio at the Future China Global Forum in Singapore and asked for his perspective on calls for stronger stimulus for the Chinese economy.
Everybody says stimulus and throw lots of stimulus at it and so on. Okay, that almost in many ways can reinforce the problem. The issue of moral hazard was, in my conversations with policymakers through this, I've been involved with all of the economic policies all the way through now, and I've had the conversation, is the issue of moral hazard and how do you get that all balanced. So just throwing a lot of money and credit, everybody says that's not, you need to do it correctly. And that's part of a restructuring. That becomes the challenging part of it.
Ray Dalio there with Martin. Meanwhile, I caught up with IMF Managing Director Kristalina Georgieva, head of the IMF World Bank annual meetings next week, and asked her whether China needs to be careful about debt levels as it looks to stimulate growth.
The number one issue for China is how to generate more domestic consumption, how to create more confidence so there could be an economy that is more geared by the Chinese consumer rather than reliance on exports. We have been working with China and advising China to move in this direction, provide more security to people, spend more money in social measures, especially reform your pension system so people feel that they can spend more. And also we have been urging China to more decisively resolve the problems in the property sector. They have taken measures, they go in the right direction. We would have to assess carefully, would that be enough to restore confidence, consumer confidence in China, and to help China take this turn towards more reliance on domestic consumption?
There's no doubt that the Chinese are trying to jolt the economy in recent weeks, one press conference at a time. How encouraged are you about the measures you've heard so far? And do you think there's a remote chance that China can get to the 5% growth target this year?
The measures are gradually creating better conditions for China to perform around the 5% target that they have set for this year. We do need to look more carefully into the totality of measures. There may be some additional fiscal measures to come forward. Our view has been that a powerful action to resolve the property sector, to clear the liabilities that come from unfinished construction, would play a very positive role. And we also have been saying to China, be careful with domestic debt, because it is at the point now when it might create more constraints for future growth. The Chinese authorities recognize that the country is not going to go back to the 8, 10, 12% growth path of the past, but they are also concerned of going down too far. Our own analysis shows that unless they pursue structural reforms, there is a risk of Chinese growth to fall below 4%, and that would create significant domestic difficulties in China.
The managing director there of the IMF talking to me about how she's been viewing China and some of the discussions that they've been having. To me, what jumped out there about the warning around too much local debt. And don't forget there have been measures in recent weeks for the Chinese to try and rescue some of those local governments, which would effectively move along some of that local debt issue that we've been discussing there. The other points raised in the conversation around the sort of savings that the Chinese are now sitting on, the fact that there isn't a safety net, and Ray Dalio also touched on that, the age of the population, that they need to retire at a certain age, need to fund their retirement, yet there's no saving schemes on a national basis for them. So hence the hesitation if you do see problems around the wealth effect. And obviously the property market, where a lot have been speculating or investing, call it what you will, that they haven't had the outcome that they want. The stock market's gone pretty much nowhere for a long time, except for this very short window of time. So in terms of banking enough savings for the future, I think there's natural caution there. On top of it, the economic growth story, trade tariffs, all of that impacting business as usual for people that might have had decent revenues in the past, not seeing it now.
Any one of those factors could be damning, but having them all together as a combination could be toxic. That's the conversations that we've had with various commentators. George Magnus wrote a whole book on it. We had him on again recently. So just tying that together again. So my questions about the market being a decent barometer for the economy, I think we can establish that very rarely is the stock market a great barometer for what's really going on in the underlying economy. We can talk about the US consumer retail sales data in a moment, which was quite extraordinary compared to other data. But let me just go back and just say, hang on, if the China data is as solid as the number we've just had really is, if it's 4.6%, if that really is the annual growth figure extrapolated from the latest quarterly figure, then why are we having all this massive amount of stimulus? Any economy that has gone through an industrialization, that has gone through an agrarian to industrial revolution, will slow down. It's economic history. It's 101. We've all read it, all of us. If they have steadied the ship since the third quarter of 2023, and I've picked that quarter because it's the quarter that takes out the ups and downs oscillation from COVID as well. 4.9%, 5.2%, 5.3%, 4.7%. That is the previous four set of data. We're roughly in the 5% band, give or take. If we have steadied the ship, why are this daily set of announcements, not daily, bi-daily or tri-daily, whatever you want to call it, set of announcements on fiscal and monetary stimulus, and so aggressive if we're going at 4.6%. Have a think about it, everyone. If we're growing at 4.6%, we wouldn't need this kind of stimulus. They obviously see something they're incredibly worried about. And I'll just draw one other link on this one as well. The biggest warnings in this current earnings season, and Barclays, Emmanuel Cour and others have been putting out a nice piece on this one as well, of saying the biggest warnings coming out of the European earnings season so far, we're about 10% into it, 10-15%, have been coming out because of their exposure to China. Think about it, whether it's materials, whether it's luxury goods, whether it's Pernod Ricard, whatever it may well be, whether it's Nestle. If you're not selling enough product in China, you're warning on it and it's affecting your shares disproportionately here in Europe.
Well, let me just provide a couple of answers here. If you think about what we've had out of China in terms of these cycles, huge industrial policy around new economy, so that sort of stimulus on the back of the reopening thing. We didn't get the natural reopening that we had in the West, but this huge pivot towards industrial policy. Overcapacity was a description used at one stage. The next wave that we've seen more recently has been this perhaps pull forward of activity to try and avoid any future trade tariffs around a US election cycle. So this window of time we've seen better numbers arguably because of that pull forward. What comes next? Well, without that pull forward, you've got to say there'd be a big gap, and of course the next gap that has to be filled is the stimulus measures we've been hearing about lately. To your point around Europe, then some of the revisions lower from the corporates, this also came up from the ECB yesterday in terms of one of the downside risks. It could actually be weaker external demand playing out. As we talk about that story, that weaker external demand can actually emanate from the Chinese market. Well, let's talk about the ECB. It has cut rates by 25 basis points, its third cut of the cycle and its first set of consecutive moves lower in 13 years. The Governing Council's statement said the disinflation process was well on track, but inflation is expected to rise in coming months before declining throughout next year. Lagarde said the decision was driven by the data.
More than consensus. There was unanimous decision to cut by 25 basis points, and we thought that it was the appropriate decision to make in view of the moment, in view of the indicators that we have, and our assessment of this disinflationary process that is really underway and well on track. That's really what. Risk of undershooting, risk of overshooting, we can debate ad nauseum on this particular matter, and you will find views on both sides of the equation. I think, what is clear to all is that we still have risks on both sides of our forecast, upside and downside, probably a bit more on one than the other, probably more downside risk than upside risk, but I'm talking here about our forecast for inflation, and that's what we are looking at.
Extraordinary comments given the 1.7% we saw in euro area inflation yesterday. Meantime, on a programming note, busy old week we're setting up for next week. We'll hear from a flurry of policymakers.
You are setting up for, not we, you are setting up for.
Well, you're going to have to listen to them as well.
Okay, well, I don't mind that.
We've got a flurry of policymakers next week when I travel out to Washington, D.C. for the IMF World Bank annual meetings from the ECB Governing Council members. So again, we're going to get a glimpse into the thinking from the ECB into the future, hopefully. We've got European finance ministers, and be sure to tune in for these conversations. There's going to be plenty of breaking news coming away next week.
Yeah, it's funny. I was looking at that list and I was thinking, wow, for a start. And then we won't mention the name, but there was one interview I thought, oh my goodness me, that will be fantastic.
We'll let the audience try and work out which one that might be.
Well, we got the list. Can we show it again?
So I think they're all going to be spicy.
Have you got it again, Roger? Sorry. There you go. So there's a lot. Well, actually, the name. Yeah,
they're all spicy, aren't they?
I'll give it. It's a gentleman. No, I don't know. Okay, I think they're all going to be great, but as far as I'm concerned, I think your Lindner interview is the one which is so important for the continent to work out what the Germans are going to do.
Well, it's the epicenter of the weakness we're seeing in Europe right now.
And it's the only country that has so much wiggle with it room.
Yeah. But in the context too, I mean, I've got to say, I'm fascinated around the language from the ECB. The lack of ability to commit to further rate reductions when the market has truly run with it and put a whole runway of rate reductions out to June next year from here.
Yeah, Robert will be interesting. Holtzman, he's like, because when we first
still looking at wage negotiations.
Well, the first conversation we had with him this year was like, nah, doesn't have to be rate cuts. And now obviously he's assented to several. So
yeah, it's like, let's just back up the truck and bring those rate reductions.
Coming up on this show, ahead of Karen doing all the heavy lifting next week, an unexpected decline in US weekly jobless claims and a surprise to the upside in retail sales. We'll take a closer look at the data. We'll take such a close look. We'll look at the control series. That's far more interesting than the headline figure. Plus, Netflix beats on the top and bottom lines as more subscribers tune in, or at least have to pay because the password clamped down. Whilst the streaming giant also sees growth in its ad business. We'll have more later this hour, and we're going to discuss what's next for the semiconductor industry with Kai Beckman, member of the executive board and CEO of electronics at Merck AG. Tune into that interview at 7:30 British Summer Time. Fascinating set. There was 5 big pieces of data yesterday. It was very interesting. Some of them were score draw, others were unambiguously positive for the economy, but less so for rate cuts. Weekly jobless claims fell unexpectedly in the US last week, declining by 19,000 after hitting a one-year high in the prior week. The labour market picture remains foggy. Well, that my autocue says foggy. I think it's robust, personally, as the effects of the Boeing strike and the fallout from Hurricanes Helene and Milton complicate the view. Meanwhile, US retail sales, they grew more than expected in September, rising 0.4% on the month. Lower fuel prices boosting spending. But again, the control series, really, really positive data in this latest set of data. And I think it was up 0.7% as well. So, I mean, that is a huge figure. No matter what the concerns are about the housing market, and they were abundantly clear yet again from the data this week, the fact of the matter is the retail picture is boosted by a strong consumer. Asian indices, Karen.
I think the markets agree with you. We had record level stateside on some of the major markets, the Dow in particular, S&P 500 during the session, but you can see across in Asia picking up on some of that green. We've got the Hong Kong market, China stocks bouncing, but some cover from all the measures we've seen lately. And of course, the latest annual GDP figure, 4.6% in the 3 months to September. So the markets are stronger. Japanese stocks are rallying almost 0.2%. Cosby in South Korea trading down by 0.6, and it was the data that the Japanese were digesting.
Do you know, if the world spent as much money on energy transition as it spends on subsidising hydrocarbons, we'd be there by now. Trust me, we would. But core inflation in Japan slowed for the first time in 5 months, easing to 2.4% on the year. What's that got to do with what I just said? Well, it comes after the government rolled out temporary subsidies, here we go again, on gas and electricity, reducing bills. Lynn joins us with plenty more. Lynn, lovely to see you.
Hey, Steve, good morning to you. I mean, there's no real surprises when it comes to this inflation data. As you said there, a lot of it was on the subsidies that came through, and therefore we saw electricity prices as well as gas prices falling for the month of September. When you look at that deeper index, which excludes both fresh food as well as fuel, it rose 2.1% on an annual basis. But that also came down a lot to this big spike in rice prices that we saw, 45% rise on an annualized basis because of the stockpiling off the back of those warnings about the earthquakes in that month as well. But when we are looking at the question about demand-driven inflation, a key gauge there is in terms of the services side, and that actually still moderated for the month, 1.3%. And you've got analysts saying that that is still a sign that in terms of what policymakers have been talking about, that virtuous economic cycle of wage rises filtering through to price increases is still remaining a bit of an open question. But in terms of what this means for the Bank of Japan meeting at the end of this month, when you look at the rhetoric that we've seen in the last month or so, it really has been this focus on the fact that they are in no hurry. Obviously, they are concerned about some of the risk events. You've got the general election in Japan next week, and then after that, the US election. And sort of this majority consensus view is that there will be no move, with December looking more like a live meeting, guys.
That's fantastic, but I think you're about to upset me because I'm just showing the viewers. You can't see this at the moment, I don't think. This is my breakfast. It's got all kinds of vegetables and nuts and seeds and all kinds of dull, boring things. It's just kind of how it is. You're about to talk about lovelier food, though, aren't you?
Yes, I am. I guess it's a national favorite in Japan, and that is ramen, but it's also very much loved by tourists as well. When we were in Tokyo a couple of weeks ago, we wanted to look at how the inflation picture has been impacting households and particularly small businesses. SMEs, of course, a backbone of the Japanese economy, employs about 70% of the population there. Let's take a watch.
In Japan, ramen is more than just a cheap and cheerful meal. It's a beloved cultural staple and a must-try for tourists. But after decades of falling or stagnant prices, inflation has hit hard. Kazunori Hasegawa has been the store manager of popular ramen chain Afuri in residential Tokyo for 7 years and counts his store as one of the lucky ones.
Costs have risen significantly, but we are very fortunate that many customers do come to our stores, so they have been helping us a lot.
Afuri says nearly every ingredient in this bowl of ramen has risen in the past 2 years. The seaweed, the pork, the wheat, and even the sesame oil.
Hasegawa says despite having raised prices twice last year, his store's most pressing concern has been wage expenses.
Labor costs are significantly higher, especially after the end of COVID. Things moved quickly, and it was hard to hire enough people to deal with that situation quickly.
Rising costs mean many shops face a tough choice: increase prices or shut down. The first half of this year saw 49 ramen stores file for bankruptcy, on track to set a record for the most closures in a year, according to research firm Teikoku Databank.
Ramen shops are a good example of the broader struggle many small businesses face in being able to pass on cost increases to customers, many fearing that even a modest hike could cause a customer backlash.
Most people, thankfully, are very supportive, and they understand the reason why we have to do this. So we are very grateful about that. But there are a few that are not satisfied with the price increases. But we try to explain the reasons as carefully as possible and hope they understand.
Of course, ramen culture in Japan isn't going anywhere. The 49 bankruptcies is just a tiny fraction of the 20,000 plus eateries across the country. Yet the increase in closures this year underscores bigger economic trends here. Although the yen has climbed since July, it's still well below multi-decade averages. Energy prices have remained elevated since Russia's invasion of Ukraine. And although wages are rising at the fastest pace in 3 decades, it's unclear when or if they will outpace inflation in a lasting way, or how much people may have to pay for their favourite bowl of ramen in the future.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.